Hello people, welcome to the channel. From today we will be starting CA final SFM classes. I'll try to finish the syllabus as soon as possible and I'll be going deep into the concepts but I'll try to solve problems as well. But I'll try to compile a few problems and make it in one so that you get better understanding and better clarity as well. So firstly, you need to understand a few basics in finance to get into advanced level. So I consider the following topics are important areas in finance. So one is analysis of financial statements. Second one is the time value of money. And third is the valuation. So valuation includes business valuation and other valuations as well. Okay, let's start. There is a huge difference in perspective when it compared with the basic accountant and the qualified business analyst in looking into financial statements. So, being a finance student, we should have analytical skills in analyzing the financial statements. So, in order to analyze the financial statements in a proper way, we need to rearrange the line items in the financial statements in a format that we require to analyze them. Okay. So basically, income statement, which is also known as the P&L account, that will be the regular format of the P&L account. If you see, it will be in the format of income minus expenditure, which includes cost of goods sold, operating expenses, administrative expenses, sales and overhead expenditure, everything is deducted. You will arrive at profit after tax, and we consider profit after tax as a profit for reporting. But that's not the same for analysis. So while analyzing the financial, while analyzing the P&L account, we need to rearrange the format into the format which I am showing you right now. That is, first we need to arrive at the operating revenues, which includes all the sales. From that, we need to reduce the cost of goods sold to arrive at the gross profit. So it is the first level at which at which profit is being calculated, which is gross profit. And from gross profit, we are reducing the cash operating expenditure, which is the out-of-pocket expenditure to run the business. Uh, it doesn't include depreciation and amortization, being which they are not cash expenditure. So after deducting the cash operating expense, we arrive at EBITDA, which is the most used level of profit. So from EBITDA, we reduce depreciation and amortization to arrive at the operating profit, which is also called as EBIT. And from EBIT, we reduce interest and finance cost to arrive at EBT. And from EBT, we reduce income. We reduce the corporate tax to arrive at EAT or PAT. From that, we reduce dividends to arrive at the retained earnings. I would say retained earnings is one of the sources of finance, which is the internal source of finance. That's more or less finishes the P&L account. And now coming to the balance sheet, it is also called as a statement showing sources and application of funds. The balance sheet is an annual financial snapshot, I would say. It is a condensed version of the account balances of the company. The balance sheet tells the investors what the business owns, that is assets, and what the business owes, which is liabilities, and how much the investors have invested, which is equity. It's nothing but, the equity is the residual interest of assets after reducing the liabilities. So we can analyze the balance sheet and arrive at few ratios which are very important in decision making, like a quick ratio, a debt to equity ratio, working capital ratio, and many things as such. Now, we'll start with the certain models to analyze the financial health of the company. So, I am taking you through the DuPont model, which basically decomposes the components of companies' return on equity, which is known as ROE. It allows an investor to determine what the financial activities are contributing to the most of the changes in return on equity. So an investor can analyze these and compare it with other companies as such to make a decision on investments. So the DuPont analysis in CRISP, what does it say? It gives the detailed snapshot of the return on equity. So return on equity has got three components: profitability, efficiency, and risk. So we'll go one by one. So starting with profitability. Profitability is calculated as profit after tax divided by revenues. So that's being contributed by three different variables. One is profit after tax, another one is profit before tax, another one is PBIT, which is nothing but operating revenue. So all these three components contribute to the profitability of the company, which is PAT, profit after tax. And PBIT can be further decomposed into cost of goods sold and operating expense. And cost of goods sold can also be further uh, tiered down into material labor revenue expenditure and other variable expenditure. So after breaking down it to the maximum level, we do variance analysis to understand the further differences from the budget, and we can make we can make the decisions strategically. And now coming to efficiency in this perspective, mainly to understand the efficiency of the assets. So it's been calculated in, I mean, it's considered in two levels. So revenue by fixed assets, which is basically means how much the fixed assets are being contributed to the towards revenue, and revenue is divided by current assets, which means how much the current assets are being contributed to the revenue. Next, risk. Risk is nothing but the financial risk, which is basically the total assets divided with shareholder funds, which is equity share capital plus retained earnings. I forgot to mention one more point in analysis of balance sheet. All the current assets, which is debtors, inventory, etc., are considered as the funds which are being blocked in the operating cycle of the company. So what it basically means is debtors, inventory, etc., are the funds which are being blocked. So unless we realize, or unless we realize debtors, we are out of cash. So which is basically means our cash, which has been put into a company, is been blocked in the form of debtors and in the form of inventory. So once the inventory is being used to manufacture finished goods, and once the finished goods are being sold, then we can say the funds have been realized. So all the current assets basically means the amount of the funds which are being blocked in the operating cycle. And same as DuPont models, companies like Tata Group, they have their own business excellence models to assess the return on equity. So many companies in the world um, basically develops their own models in order to analyze the return on equity. And there is one more this thing which is considered as a yardstick to understand the financial health of the company. That is nothing but Altman's Jet score. So Jet score is one score which is analyzed by the investors before flushing their funds into the company. Let's say the company is going for IPO or any other funding. So the investor or the person who is investing into the company need to understand the financial health of the company. For that, he looks at the Altman Jet score. If it is positive and available, then only he'll invest into the company. So Altman Jet score is one of the key indicator of the financial health of the company. And that's it. It wraps up the concept of analysis of financial statements. We'll try to upload one more video on the upcoming topics very soon. Until then, stay safe, stay home, peace.